Hello, everybody. This is Tim Travis, CEO of TNT Capital Management. And today we are going to go over our 2025 investment outlook. Okay. The last 2 years have been pretty strong for the overall markets, but there's also a lot of signs that the market could be toppy or a little bubbly. And I think there's quite a few risks out there that are being underappreciated. So let's go ahead and get started. Investing in the financial markets involves the risk of loss. Options are not suitable for all investors, and past performance is not indicative of future results. How do we invest at TTCM? So we look for undervalued stocks and bonds that offer less risk and better returns than the overall market over the long term. In addition to these types of securities, we're going to employ conservative measures such as covered calls and cash secured puts to further enhance income and reduce risk. We don't do any speculating whatsoever, and our priorities are on minimizing permanent losses of capital and maximizing risk-adjusted returns. Here's a quote I like from Seth Klarman. He says, "Uncertainty is not the same as risk." Indeed, when there's great uncertainty, such as in the fall of 2008, it drives securities to prices that are especially low levels, so they often become less risky investments. So that's a helpful way to think about things. Sometimes when everyone's pessimistic, that's when the best opportunities are. Conversely, when everyone's optimistic, as I'd argue now as far as financial markets go, the risk is far, far, far greater, and people really aren't factoring that into consideration. So as we look at market valuations, we look at the S&P 500. The current Shiller, which is the inflation-adjusted PE, is 37.5 times. That's 39.8% higher than the recent 20-year average of 26.8. Okay, so on an inflation-adjusted basis, these are top valuations. The regular PE ratio using last year's earnings stands at 29.7, which is 80% higher than the historical average of 16.5. The 10-year Treasury yield is currently yielding about 4.54%. It's really head up materially. And this should be concerning for people because bonds tend to move inversely to stocks in many ways. When rates get higher, stocks should trade at a lower multiple because the risk-free rate of return is higher. Junk bonds are yielding about 7.25%. So you've got some opportunity there with yields where they're at. We've definitely dabbled in that. Spreads are not super wide. The ISM manufacturing PMI has been below 50, so it's in contraction for 25 out of the last 26 months. This is something we have never seen. Okay, so there's something wrong under the hood that I don't think you're seeing in some of the economic data outside of this because of all the money printing that occurred. There's been some funny business in terms of how the jobs numbers have been reported and then revised and things like that. So I think the economy is not as strong as people think. And the S&P 500 price to book ratio now exceeds the March 2000 high. Staggering. So here's a quote from Niccolo Machiavelli, one of the great philosophers in Florence, Italy, back in the Renaissance. And he says, "It is a common fault not to anticipate storms when the sea is calm." Once again, despite all the geopolitical craziness that's out there, okay, so that's a storm. But the stock market, the Bitcoin, gold, these have all been really strong performance. And so people aren't really taking into consideration just how risky things are. If you're 100% invested in S&P 500, are you prepared for a 40% sell-off, a 50% sell-off? What if you're close to retirement or retired? What we see in the portfolios that we review, we get calls to our radio show and stuff like that. We're seeing people are taking way too much risk. I mean, you'll see 70-year-olds that are living off their portfolio that have 80% stock allocations. And it works when in a bull market. But when you get that bear market, this changes your retirement, and you only have one retirement. So we need to take steps to protect you. So here's how we set you up for success. So every investment is handpicked and thoroughly researched based on deep value principles. We build focused portfolios based on maximizing risk-adjusted returns as opposed to the overly diversified approach others take. And then we utilize strategies such as selling covered calls and cash secured puts, which can potentially generate reasonable returns even in a bad market. And so generally, these strategies result in less losses in bear markets. So look, outperforming when the market is up is great, but it's not nearly as important as outperforming when the market's down a lot. Okay. Like if so taking these steps when the market is overvalued is when you want to do it. When you wait for the sell off, it's almost too late. So, margin of safety. So, here's the basic concept of this. So, a stock is a fractional share of a business. Every business or stock has an intrinsic value. The intrinsic value of a business, it generally changes at a much slower rate than the price of a publicly traded stock can change. So the intrinsic value is based on the cash flows, the assets, the liabilities of the business, the margins, the competitive advantage, those sorts of things. And so that's what we do is we spend our time analyzing these to become competent at valuing different industries, different types of securities. Now, over time, the intrinsic value of a business and the stock market value of a business converge. It could take 90 days, it could take 3 years. The timing is always the most difficult part. But by buying the business at a substantial discount to intrinsic value, you are thereby creating an adequate margin of safety. So here's one that Warren Buffett says. He says, interest rates are to asset prices what gravity is to the apple. When there are low interest rates, there is a very low gravitational pull on asset prices. And then he also says, I would consider a year in which we decline 15% and the Dow declined 30% to be much superior to a year when both we and the average decline 20%. So once again, you want to lose less money in the bear markets. That's the key to protecting your capital and growing it. It also sets you up to switch from defense to offense. Now, options. So according to the Chicago Mercantile Exchange, about 3/4 of all options held to expiration at the CME expired worthless during a 3-year study. So that's kind of what we see, roughly three-quarters tend to expire worthless. So we use them as a tool. We use them as a tool to add an element of timing, which you don't have when you're just buying stocks. We use them for the purposes of generating income, reducing risk, lowering our cost basis, and selling at prices that we are comfortable selling at. No speculation whatsoever. We don't do buying of options. Not that there's anything wrong with it. It's just not our game. We want the odds stacked in our favor. So here's a stock, okay? Crown Castle, ticker symbol CCI. So on January 4th, the stock was trading at $89.99. It's actually, as I record this, it's actually down. It was down a bit on Monday, so it's actually cheaper now. But we like this stock quite a bit, and so we're buying it. So it trades right around its 52-week low, and 24.4% below its 52-week high. Its 52-week high was 119. Okay. Now the dividend yield at the price $89.99 is 6.956% because the stock pays a $6.26 per share annual dividend yield. Now the stock trades at about 12 times AFFO. That's kind of the best earnings number for real estate investment trusts, such as Crown Castle is. And so to put that in perspective to its historicals, it normally trades, the AFFO multiples normally in the high teens to low 20s. So, 50% upside, I don't think is out of the question. Now, one of the reasons why the stock is cheap right now is because interest rates have been going up. Okay, so that pressures most real estate assets. And secondly, when Sprint and T-Mobile combined, when they had their merger, they got rid of some of the redundant tower assets. CCI and its competitors are kind of in a period where their growth is a little halted in the short term, just like really this year, whereas it will start picking up again, kind of going into 2026 mostly. And so it's just, normally they grow a lot faster. It's just one of those periods. You just kind of have to wait for that to fix itself. And it will. It's happening already. So if the stock trades at just 15, remember we said 18 to the low 20s was the normal multiple. If it trades at 15, it's AFFO of 755. the price would be 113.25, which is 26% higher than the current price. Plus, you'd collect that 6.96% dividend. So very attractive. I don't see a lot of downside in this stock. See a lot of upside and a great yield. BHP Billiton, okay? Great large miner. You got iron ore, you got copper, you got a variety of different metals in Australia and across the globe. And this is a stock that we like a lot. We've done a lot with it over the years, but right now it is trading at its 52-week lows. And so on January 4th, it was trading at 48.81. So what we're going to do is we're going to sell puts. So we're going to sell 1 January 2026 $47.50 put for $4.80 per share on 100 shares in one contract. That's $480 total. So we're collecting $480 up front. Now, our maximum risk on this trade is $4,270 if the stock were to go down to zero, okay, which obviously we don't expect to happen. But so when you think about this, options are pretty simple if you use them this way. It's like the flip of a coin, heads or tails. Heads. If BHP expires above 47.50 in 377 days, you will collect the full target profit of $480 or 11.24% on the maximum risk. This equates to a 10.91% annualized yield. If BHP tails, okay, if BHP expires below 47.50, you're going to end up owning 100 shares at a break even of 42.70, and you have all the upside or downside from there. Therefore, the stock could go down 12.51% by expiration before you lose a penny. And the dividend yield at that price would be 6.8% per year, given the $2.92 per share annual dividend. So very, very attractive. Once again, you get a double-digit yield if the stock's above 47.50, which we think is very likely. We think the stock could be worth 55, 60 easily. And worst case, you own it at a much bigger discount with a huge dividend. And when iron ore comes back and copper comes back and these metals start performing better, huge upside in BHP. So let's go ahead to the next one. Covered calls. So using the same stock, buy 100 shares of BHP at 48.81. Now we're going to sell 1 January 2026 52.50 call for $3.50 a share or $350 total for the contract. The maximum risk on this trade is $4,531. Once again, folks, heads or tails. Heads. If BHP expires above 52.50 in 377 days, you will collect the full target profit of $369 of upside on that stock to 52.50, or 8.14% on the maximum risk, plus the $350 from the calls, plus another $292 per share from the stock dividend, for a total of $1,011 or 22.31%. This equates to a 21.66% annualized yield. So heads, stocks above 52.50, which it's traded at much of this year. You make 22% on your money. Fantastic. What's tails? What's the worst case? Well, if BHP expires below 52.50, you will own 100 shares at a break even of 45.31. And you're going to have all of the upside or the downside from there. Therefore, the stock could drop by 7.1% by expiration before you lose a penny. If you also add the $2.92 per share dividend you collected, that lowers your break even further to 42.39, which is 13.15%. And you could sell another set of covered calls from there. So I want you to think about something. A bear market is a 20% decline. Okay, so let's say you take a bear market in BHP stock, down 20%. Well, using this strategy, you're only down 6.85%. Because you're getting 13.15% of protection. And now you own this stock at a fantastic price. It could double from there. and at least 50% upside. So often we'll make the most money when we actually get exercised on a stock, or when the covered calls expire and we can ride the recovery. So we like all the scenarios on. Last one I'm going to show is a trade we did earlier this year. So Arbor Realty is a commercial mortgage investment REIT. What they do is they do a lot of bridge loans and things like that on mostly apartment buildings. Okay. So apartment buildings are a great sector, but there's oversupply and higher rates. So that's pressured everything. So, they have some loans that some mortgages that are struggling or needing to be refinanced and recalibrated. There's some prominent bear analysts that hate this stock. And so you get a lot of volatility. And so on February 19th of 2024, the stock was trading at 1205. And so what we did was we sold 10 January 2025 $5 puts for 85 cents a share, or $850 total, because $85 per contract, 10 contracts, $850. If the stock goes to zero, we lose $4,150. Okay, so that's our maximum risk. Now, once again, heads or tails. And remember, when I'm saying this stock was at 1205. Heads. If ABR expires above $5 in 340 days, you will collect the full target profit of $850, or 20.48% on the maximum risk. This equates to a 21.8% annualized return. Phenomenal return, right? I mean, we'll take that any day of the week. I don't care what the market does. But here's the thing. What's the risk profile? Well, if ABR expires below 5, you're going to own 1,000 shares at a break even of $4.15. And you have all the upside or downside from there. Therefore, the stock could go down by 65% by expiration before you lose a penny. That's the type of risk reward that is so compelling. And you can do that when you combine fundamental analysis and tactical, strategic option strategies with that value basis. It's a fantastic set of opportunities. So that trade's worked out really well. The options expire in a couple days in January. So the stock's well over double digits still. And some of these we've already taken the profits, but yeah, so very good trade. So that concludes the presentation. Thank you so much for joining us. We're going to try and do these more often. It gets hard sometimes. I understand there's a few typos here or there. I try and balance getting good quality content at a reasonable time too, because it does take time, and we've got a lot of responsibilities and stuff like that. So forgive me for that, please. But our firms, my name, Tim Travis, once again. You can email me directly at tim@ttcapitalonline.com. My direct line phone number is 805-886-8140. And our website is ttvalueinvesting.com. Our primary custodian is Schwab. We also use Interactive Brokers. And what our most popular account is the managed account, where we hand select each and every stock for your portfolio. We do IRAs, we do cash accounts, we do financial planning. We do a lot of different things to help you, tax planning, all these different aspects of the investment picture. And so we'd love to help you out. Please give us a call. And thank you so much. Have a great day.